So if there's one thing I'm passionate about, it's not paying freaking taxes. Oh my gosh. And Mark hates it when I say that, but man, I hate paying federal income tax. Absolutely can't stand it. And I'll tell you, one of the smartest men ever to walk the planet, little guy that you might recognize by the name of Benjamin Franklin, once said, the best way to save money is the avoidance of tax. Now, so that Mark doesn't get mad at me, I'm going to stress the difference between avoidance and evasion, two very different things. But let me tell you something. I feel like I know a lot of people around the country, and I feel like, I've been very successful, had lots of great connections, and I feel like I'm a pretty good judge of who knows what they're doing when it comes to this stuff. And it took me a lot of years, I mean, a lot of years of good accountants and actually some really, really good CPAs and some really good attorneys to get to the best. And without, making it so he can't get his head out his office door later today, I will tell you, Mark is the absolute best. And I've asked him to join me today to share with you guys some end of the year tax strategies. And this is not just for real estate agents. This is for everybody. Now, we will talk about some stuff that is specific to real estate agents also. But here's the deal, guys. If you're a real estate agent today, and Mark's going to scold me for this, but I'm going to say it anyway. If you're a real estate agent today, or any kind of a real estate professional, and you own rental properties, and you are still paying federal income tax, it's because your CPA sucks, because you don't have my guy.
I can live with that one. That was okay. Yeah. That was good. You put a couple caveats in there, and I would stand behind that one wholeheartly. So good call.
I mean, the end of the day, when you have people that know what they do, I look at it like this: like the money that I pay for taxes, or sorry, for tax prep, I should say, the money that I pay for tax prep, that's just fire prevention, right? I mean, it really what it does is it allows me to not pay federal income tax legally. And by the way, I've been audited twice in the last 3 years, and guess what? Never a problem. Why? Because these guys do it right. Mark and his guys know what they're doing, both on the legal side and on the tax side. So Mark, I really appreciate you being here to share with us today. And if there was only one flaw, and I do feel I've got to be balanced in this, and if there was only one flaw that I think I'm duty bound to point out, it's that Mark's a skier and not a snowboarder. And so other than that, he's the man. So.
Yeah, thank you. For those snowboarders out there, that might be hard for you to swallow. Well, thanks for having me today. For all of you listening, and I take it, Michael, we're on multiple platforms. We're off on YouTube here, there, and Facebook, blah, blah, blah. I only see you. I don't see chat. So I'm going to rely on you to garner any questions. And I want everybody to know we're here live. This is, Tuesday the 9th? I have to hold up a paper. So we're here live. So please submit your questions. We'll try to get to as many as we can. Next, I'm going to cover the top 5 year-end tax strategies that and frankly, I like the way you said it. I don't care if you're a realtor, a broker, a dentist, a doctor, an engineer, online marketer, NIL athlete, any of you, these 5 could work for you, maybe all 5. So we're going to talk about those. I know, Michael, you also want to go through a case study on a rental property for any of you that did purchase a rental property this year or in the throes of closing. We can talk about why it's so important you do close by December 31st and some techniques and strategies there. So I'm all yours, everybody. We do have a 25-point checklist of year-end strategies we just held recently at our law firm. It's on our website as a full hour webinar. We'll give the link out to that later. We'll give you some resources to get to everything. But these 5 strategies I think are critical. We're going to have fun. We're going to cover those. I'm going to go to the whiteboard here. Look at this, bad boy. We're going to go here.
Holy cow, you need a bigger whiteboard. That thing's huge.
Oh, it's the Vibe board. I love the Vibe board. I can just.
Do you really?
Oh, they're so cool. I can move it. I can copy it, and I can do all sorts of things and email it, and then knock out anything here. Zoom in, zoom out. It's so fun.
I'm going to have to keep up with the Kohlers and get me one. That's pretty cool.
Oh, well, I've got a switch here that's fun too. Okay, well, you lead the way and tell me what you want to talk about first, and then we can take questions on each topic, and then we'll move to the next one.
All right, so let's start with this. Everybody, as you have questions, type them in. If you have tax topics that you want to talk about, type them into the chat. I'm following the Facebook comments right now. That being said, Mark, I want to start off with something that I get asked a lot. I mean, literally almost every day I get asked this question, and I want you to take us through the math. If I am a real estate professional, and whether that's agent or appraiser or full-time investor or whatever qualifies as a real estate professional according to the IRS, and I buy a $500,000 rental property, walk us through this thing called accelerated depreciation and the math behind how much additional money do I now get to save on my taxes first year and then years 2 through 5, et cetera.
Okay, we'll do it. And I wanted to give two other side notes based on that introduction Michael gave. I am a CPA, an attorney. We have a law firm that serves clients all over the nation. And I've also been creating a Main Street Tax Pro network with now over 1,500 accountants trained on over 90 strategies, 900 quiz questions, and weekly classes with me to be on that network. We can give that to you later. I make no money on your relationship with that accountant, but we have a network where you can find an accountant that speaks Mark Kohler and Michael Hellickson. So we can set you up with that as well. And by the way, Michael getting audited twice in 3 years, holy shit, he's like a lightning rod. Our clients do not get audited. Our goal is to make sure they don't. Poor Michael, he's like, I don't know what happened.
You know what though? I gotta say this though. I actually don't mind it, because really for me, it's, first of all, I pay zero taxes. Second of all, I should say federal income tax, to be clear. But second of all, an audit for me is a 20-minute three-way call with my CPA and with the IRS, and then they deal with it all. It's Mark's guide, by the way. I don't have to deal with anything beyond that. And so audits mean nothing to me. I'd say it really doesn't bother me at all. And I'm really happy to trade not paying taxes for that. And so I'm very happy with that.
Well, good. Okay, well, let's go to the whiteboard then. And the first thing I want to point out to everybody is there's 3 real estate deals where you can get bonus depreciation. And one of them is real estate professional. So when we do our trifecta that Michael and I talk about all the time, over here you've got your operational business. Over here you may have a rental property. If you're a real estate professional, a rep, you could have a long-term rental, commercial rental, short-term rental, whatever type of real estate you want. And as you qualify as a real estate professional, we can unlock depreciation. That's option 1. Option 2, you could be a short-term rental investor and not be a real estate professional, but take advantage of the short-term rental loophole. My wife, Patty, and I are doing this. We are closing on our 4th short-term rental. We did a month and a half ago. We're putting in our 100 hours. We'll have our material participation loophole finished, and it is for rent in the next, actually 2 to 3 days. We need 3 rentals by December 31st, and we've got our write-offs. So you could be a short-term rental loophole, and that would work, and you don't have to be a real estate professional. The third is if you buy your own building, which I know Michael has done as well, as I have, and you rent it to your own company. That's called a self-rental. You don't have to be a real estate professional, nor do you have to put in 100 hours. It is the creme de la creme, because guess who your best renter is, people? It's you. So if you own a commercial rental and rent it, and you have the same ownership percentage, whatever that is, with the operator, which is typically you, that qualifies as a -4 self-rental. So in these 3 situations, we can unlock depreciation. It's not just real estate professional. Point number 1. All right, so let's say you go buy this $500,000 property, and let's go with a typical single-family home rental. Again, it could be a commercial, but it would be typically a commercial condo if you're going to be at the $500,000 range. So you've got this little rental property. It's adorable, and here it is. And the purchase price was $500,000. All right, well, when you go to do this little box around it is the land. You cannot depreciate land. So the typical allocation is going to be 20%, which can vary depending on the location. But we're going to take 20%. So we're going to start with 500 grand, and we're going to take 20% off the table. So that's going to be 100 grand that'll come off for the land. Now, your mortgage, your down payment, do not care. I don't care what your mortgage amount is. You could have bought cash. You could have put down $1. Do not care. For the tax write-off, it's all about the basis and the improvements. So 500 grand, we take out the land, you've got a $400,000 building. Now, typically, you would depreciate this over 27 and a half years, straight line depreciation. I mean, we could have fun here. Siri, 400,000 divided by 27 and a half. Your depreciation would be approximately $14,000 a year. That would be your base. Like we say, that'd be baseline. If you were to not do anything else, 14K a year, that's your write-off. Boring. We don't like that. So the strategy is, I want to take advantage of this bonus depreciation in the one big beautiful bill, 100% ability to write off any property that is 15, 7, 5, or 3-year property. Because I can't bonus depreciate the structure, like the foundation, the framing, anything that is a 27.5-year property. But think of blinds, carpet, landscaping, fencing, roof, HVAC, any of that that's 15-year, 7, 5, or 3, the one big beautiful bill says you can depreciate that all at once, accelerate that write-off, and use that write-off right here against any other income. So if I qualify under one of these 3 reasons that we talked about, this loss I can use against my S Corp K1, I could use it against a W-2, I could use it against crypto income, real estate income. This loss is unlocked. So if I can unlock a huge depreciation write-off, I can use it anywhere. And so my 1040 becomes a big smoothie. And I'm going to turn that blender on, and I'm going to use that loss on any other type of income. So we get back here and we say, okay, well, how much can I do of this? Well, we got a $400,000 building. To find out how much property is 3, 5, 7, or 15, I've got to do what's called a cost seg, a cost segregation analysis. You cannot do it yourself. Your accountant cannot do it. Your lawyer cannot do it. You have to get a third party. It has to have a site visit. I like engineering services. We use them all the time. We'll put a link out here if we need it. If Michael, you've got a contact you like, I'm cool with that. Shop around people. You're typically going to spend around $3,000. You're going to spend $3,000 for this cost seg analysis. Now, typically on a single family home, about 40% of it is going to be allocated to 3, 5, 7, 15. So if I take 40% of $400,000, that'd be 40 times 4, that's 6, that'd be 160,000, is that right? Let's do it. 400,000 times 0.4. 160,000. So we're going to take 160,000, which would be the 15, 7, 5, or 3-year property. Sometimes that's referred to as chattels. So this 160 grand, 10% of 400 times 4 is our 160. I can now bonus depreciate. So this 160 grand becomes our big write-off in year 1. So year 1, I get 160, right now, people, you get that write-off right now, 160 grand. The remaining 240 is now over 27 and a half years. 240,000 divided by 27 and a half. That's another 8,700. So now instead of 14,000 every year, you get 160 up front, and then, sorry, Siri, and then another 8,700 every year thereafter. And that becomes my new depreciation. So if we go back to our trifecta here and we say, okay, I'm going to knock this out. In fact, let's do a fresh one. So you've got an S Corp, you've got a W-2, a K1, your husband or wife has a W-2, you've got all this income over here. Let's say you've got 160 grand of income on W-2s or small business. Now we come over here to your 1040, we take your LLC that owns the rental property, and we carve out a $170,000 write-off. It wipes out your other income, and people, you are now in tax heaven, 0 tax. This is called a taxgasm. It's exciting. This is like tax porn. It's so fun. And we have just written off all of our income. And what's cool is you now have cash flow from your rental property. You have future appreciation that's growing tax-free, and you're making more money over here than you would have paid probably a 30, 25% tax rate on this. Oh my gosh, there's probably 50 grand that you saved in taxes, And what do you use with that 50 grand in January or Q1? You go buy another rental and you do it again. And then you take the savings from next year and do it again. And then 5 to 10 years from now, you've got 10 properties producing cash flow, and that becomes your future wealth, not to mention the equity. And you did it all with the IRS's money. That is the secret to bonus depreciation in real estate and small business.
Okay, so this is huge, Mark. So I want to jump in and I want to ask you just really quick, a couple of things. Number one, if I'm correct, so let me add this spot so you're seeing us both here. So on that $500,000 house, my tax deduction ends up being $160,000, which is not the tax savings. I would then take that number, essentially, correct me if I'm wrong, and multiply that by whatever tax bracket I'm in, and that would be my theoretical tax savings. Is that correct?
That's correct.
Okay.
And you can match it up dollar for dollar with what you would have paid tax on. So that's why I used that example.
Right.
But yeah, your tax savings, that's just for fun, 160,000 times 25%. 40,000. So you're saving taxes of 40,000. And that's
if you're in a 25% tax bracket.
That's a 25%. Yeah. Which effective rate, is going to, because we have a graduated tax rate, 10, and then 12, 22, 30. So you're going to end up in that 25% range, the bulk of America. And so then you put state on it. Now you're in a lucky state of Washington with no state income tax.
For now.
Yeah, most people hit another 5 or 10 there. So they're at 30. But the beauty here is that if you go to buy this property, you're going to put 10% down, get creative financing, seller financing, whatever. You're going to put down 50 grand. Well, you just saved 50 grand in tax. So you're taking the 50 grand you would have given the IRS to buy the property, and now you're building wealth and cash flow. And then you do it again. And you do it again.
Exactly. Exactly. See, this is the thing that people don't realize is how valuable this can be long term. And I'm telling you, most CPAs are doing this wrong. It's funny. It's crazy to me how often I'm hearing from people saying, yeah, we didn't accelerate the depreciation on my rental properties. I'm like, first of all, and close your ears on this one, Mark. If you're using H&R Block to do your taxes, you deserve to be poor. Sorry. I'm just throwing it out there. Those guys are hacks. They have no idea what they're doing. Guys, they're going to tell you not to do this because, what if you sell the house in 5 years? Well, then you have to do depreciation recapture. Well, no, you don't. There's ways to avoid depreciation recapture too. Go ahead, Mark.
Yeah, there are. And I want to say this to everybody. The general rule is accelerate, wipe out your other income. But you also want to be strategic. There may be a situation where you're like, I've got an exit coming up on my business next year. So you could take a couple years of rentals, then cost seg them, and bundle them up and cost seg them in a following year to offset a big windfall you might be having. And you may want to, what's beautiful is you can cost seg it and then you can get surgical. You can say, I'm going to take 50 grand of it, drop me into the lowest tax bracket, still pay a little tax, then kick the rest to next year. So you can start being really strategic with your income. And if your accountant isn't having this conversation with you, you've got the wrong accountant. And people, I want to feel your pain when you walk into your accountant and go, hey, I saw this presentation with Mark Kohler on accelerated depreciation and this and this. If they don't bring you the idea, what do you think they're going to say?
That's a bad idea.
Yeah, they either have to villainize me and say Mark Kohler's too aggressive. They have to say, nope, it's a bad idea, or you don't qualify, because the one that is not acceptable in their brain is that, oh, yeah, I should have told you. So you're fighting an uphill battle. Now, if you get the lucky accountant that goes, you know what, I've watched Mark Kohler before, or they may put it on you. They may go, I had no idea you wanted to tax strategize. Let's sit down. Say, okay, well, now we're best friends again. So they may own it and say, let's get together. Because it could be on you too, people. You avoid your accountant because you think there's no options out there. You think tax is what it is. It's not. You're the captain of your ship. And if you're steering the ship the wrong way, that's ultimately on you too. You got to throw over your advisor, get a new one, and realize it is so easy to save money in this area.
I 100% agree. Okay, so if I'm understanding correctly on the cost seg piece, I should say on the accelerated piece, essentially what we're talking about is on a typical house, we're talking, the typical single family rental property is probably about 40% of the house's value in ultimate deduction. Is that a
Yeah,
rough
you're going to
kind of?
take 40% of 80%.
Or yeah, I'm sorry. Okay, 40%
Yep.
of the improvement value, not of the land. That's correct.
Right,
Yeah.
right. Yeah.
Yeah.
And then also you get to accelerate any improvements. So I would carve
Right.
that out a little different because if you're doing a short-term rental, you're going to go and throw 40, 50 grand in furnishings. So you've got to take your land off, take your building, then add in improvements, and then, take 40% of the building, then plus that, any improvements. And so there's some fun there. You can really, be surgical about it.
And again, guys, it carries over. So if for any reason whatsoever you don't need all of that deduction this year, you don't need to take all of the deduction this year. You can use that deduction in subsequent years. And Mark, correct me if I'm wrong. The bill shows that the Big Beautiful Bill gives us 100% accelerated depreciation from January 19th of this year all the way through December 31st, 2030. Is that correct?
Yeah, we got a while to play with this.
Yeah, that's good stuff.
And what it does is stimulate the economy. That's the goal. And because there's a ripple effect. You go out and do this and then improve it. You just helped a furniture store. You helped a landscaper. You helped a contractor. And then they turn around and spend money at the grocery store. And so this bill has a ripple effect with the gross national product. And the government makes taxes on the domino effect. So you're not evil for doing this. The government was very intentional about this. Some people are like, oh, I can't believe you're taking advantage of this loophole. The government wants you to.
That's right.
You throw in opportunity zones on the top of this. They are creating zones where you put this on steroids.
Tell us about that. What's that look like? If you're buying in an opportunity zone, how big a difference is it?
Well, if you did the same equation in an opportunity zone, you then, if you pulled money from a capital gain somewhere to do it, you get to defer that. Then if you buy this property and hold it for 10 years, you never pay tax on it ever. And that depreciation recapture is gone forever. So they want you to go buy a property in an area that needs help and improvement. Every state, so in 2027, all the governors in the country are choosing their zones. So this is going to kick off in 1/1/28. That's when the opportunity zone is really going to come back to life because the Big Beautiful Bill says, hey, we don't know what's best in freaking King County, Washington, or Maricopa County, Arizona. You governors, you go tell us where you want investors to go, and we'll give them an incentive. It's like the perfect partnership. Heaven forbid the governors work with the White House.
That's huge. Okay, so I've got some other questions here for you, but I want to ask those once you've gone through, because you had 25 points you wanted to go through, right? I'm sorry, it's five. It's five.
Well, I'm going to do 5, and I'll tell you everybody where we're going here.
Okay.
We're going to do 5 year-end tips. And literally, people, the buzzer is December 31st.
Yeah.
If you do not take advantage of these, your accountant cannot revive these later. This is it. Now, I've got 25 of those. They kind of get smaller and smaller in scope, but then one of them could be huge for someone because you never know. But these 5, I think they affect almost 90% of my clients. So we're going to go over those, and then we can unpack them and go wherever you want after this. I know we're going to go a little over the top of the hour, and I'm okay with that. So number 1, we're going to talk about the S corporation. Some of you need to take your LLC and elect a retroactive S election. Some of you already have an S corp, but you got to peg your payroll before year end and how much you're going to do in payroll and call it reasonable comp. We're going to talk about should you put your spouse on payroll in that process. And so that's a big question. Number 2, we're going to talk about the solo 401k. In the One Big Beautiful Bill, it said to small business owners, if you set up a solo 401k and do an automatic enrollment provision, which is essentially the government trying to say, please save more, please quit relying on Social Security. We need you to start saving more. So there's a solo 401k tax credit. Now I'm truncating it down to a term of, I'll give you more detail when we go over it. But the point is, you as small business owners, you can set up a solo 401k and get a $1,500 tax credit, not a tax deduction. So you would, if we went with that 30% concept, you would need a $5,000 expense to save $1,500. So the government's giving you $500 for 3 years in a row to just set up the plan and you get a write-off to set up the plan. So you're making money to do this. Your deadline's at the end of the year. So we're going to go over that. Number 3, should you put your kids on payroll and how? So I'm talking about kids under age 18 that you've already been supporting all year long in the household. How do you take a write-off for the support of them in the household because they are helping you in your business legitimately? And then what about your 18 and olders? How do you do that? So kids, if you don't pay them before year end, you cannot manufacture this later. 4th, I want all of you to hold your family board meeting in the next 3 weeks. All of you have a family office. You do not have to have $100 million to have a family office. It is my mission in life to make sure every family knows they have a family office, they have a family board, they need to use it, treat it, and write off travel and dining during the holidays to meet with their family. And it's legit. Number 5, we've got to talk about healthcare. It is healthcare enrollment right now. Have you got your HSA plan? Are you doing an HRA? Are you doing a flexible spending account with the use it or lose it? Medical expenses are the #1 reason for a bankruptcy in America. And small business owners feel like they're outside of the boundaries because they don't have a company plan taking care of them. I want you to shift that mindset and know you are in control and have more options than you realize, but you've got to get actively involved in the conversation. So we're going to talk about healthcare and how to get some big write-offs before year end and better manage your healthcare expenses. Those are the 5.
Dude, this is huge. And dude, let me tell you, we are, and Mark, you and I are going to be hitting the slopes, and don't worry, I wait for skiers. But we are going to be hitting the slopes during my board meeting, or I should say during part of the time that I'm there doing my board meeting in Park City. So very excited about that one. So hit it, man. Let's hear. So let's start right at the top.
I'll bring you over to Mayflower. We're season pass holders to Deer Valley. We'll put you on the bunny hill. And
they won't let my kind in there, man. We're the low class.
It's called skiing. We're going to put you on some skis and push you down the bunny hill, and then you'll feel, oh my gosh, this is real life. You know, it's like,
oh my gosh, you're killing me, man.
No baggy clothes, no smelling of pot. You know, like you're going to just love it. It's going to be amazing. The snow is carved beautifully. Okay, all right, guys.
I love it. All right, let's hit it.
Club Wealth is the only coaching company on the planet that will literally guarantee that you will double your income or make at least an extra $100,000 your first year coaching with us, or we will give you 100% of your investment back. Click the link below, sign up for the appropriate tier level, and let's get you a strategy session today. And I promise you, I 100% guarantee you, promise you that you will walk away with a heart full of gratitude for the time that we took for you because you got so much value out of that call. Schedule your strategy session today. I promise you'll be glad you did.